Good morning, and thank you very much for participating in this live webcast on Uruguay's macroeconomic outlook and financing plans for 2018. The presentation will be led by Mr. Antonio Juanbels, Deputy Director of the Debt Management Unit at the Ministry of Economy and Finance. It will be followed by a brief Q&A session. I now give the floor to Mr. Juanbels.
Thank you very much for joining to this video conference, Uruguay Macroeconomic Outlook and Financial Strategies for 2018. I will be focusing in these 5 chapters. We will start giving some feedback and a global picture of the recent macroeconomic evolution, what's happening in terms of the external sector, how the Uruguayan economy could decouple from the region, and the social stability. Then we will go to the recent inflation trend and the fiscal consolidation plan that the government is implementing. After that, we will move to the central government indicators. And then we will present the milestone that we achieved in last year in terms of nominal peso, the development of nominal peso curve. And after that, we will be ending with our main idea for the financial plan for the current year. After that, we are open for Q&A. In terms of growth, as you can see, Uruguay registered a very strong growth in the last decade. For the last year, the estimation is 3%, an expansion of 3% in real terms. We are waiting for the final data that will be released by the central bank by mid-March. For the current year, also the expectations are in line with 3%. The government and the private analysts estimate this rate of growth. Given this strong growth and given that the population in Uruguay doesn't grow in the long term, Uruguay ended last year at the top of the ranking in terms of GDP per capita, with a GDP per capita measure in US current dollar about $17,000. Sorry. In terms of the Uruguay in the performance in the region, as there is a structural change in our economy, Uruguay could grow even though our main neighbors entered into recession and in the last year. Here we present a graph that we show how was the cumulative economic growth in Uruguay compared with our neighbors. And taking into account year 2011 with base 100 at this year, during the last 6 years, Uruguay could accumulate a growth, and the difference between Uruguay and the neighbors was in around 16%. This is very important because this trend continues in recent years. And looking ahead for the current years and for the future, we see that Argentina and Brazil also are recovering. And for the first time in several years, both countries are expected to grow at around 3%, between 2.5 and 3%. So it is a very good news for us that both countries started recovering in the recent quarters, and the outlook for not only for this year but also for the next year and the medium term are pretty good for them. In terms of the external sector, this is the evolution of the current account balance after registering a deficit of around 4% 5 years ago. Right now, the current account turned into surplus field. The last data is as of the third quarter of 2017, and show a surplus of 2.3% of GDP. This number was explained basically by a very good diversification in terms of market. Also, we have been registering a very important tourism export in recent years. And there is another factor that worked and was had a very positive impact in the case of Uruguay. That was the very good and very promissory evolution in the terms of trade, because Uruguay is a soft commodity exporter and an oil importer, and in recent years, compared with our peer group, the terms of trade work as a hedge against the slowdown in oil and metals. The external position in Uruguay is very strong also. The international reserve represented almost 28% of GDP at the end of last year. All the metrics show that Uruguay has a very comfortable situation in terms of international reserve. International reserve covers at least 1 year and a half of total imports. And also here we present the reserve adequacy metric that is elaborated by the IMF. Here, taking into account the peer group in Latin America, Uruguay ranks very well in the third place. And even if we take into account all the emerging market universe of around 80 countries, Uruguay ranks in the sixth place. So it is in a very healthy position. The other key pillar for our credit is the strong institution that Uruguay has. Here we present some of the main indicators that show that Uruguay is a bastion in terms of institutional strength. For example, Uruguay is the only country in Latin America ranked as a full democracy by the Economist Intelligence Unit. We have a very low corruption perception levels according to the last indicator of Transparency International. And if you add this other important indicator, we are in the first place, in some case in the second place or third place. But if we see the historical series, not only the last indicator, but if we see the historical series of let's say the last decade, Uruguay always is in the first or second place, sharing with Chile and Costa Rica this place. If you take into account all the global picture, Uruguay ranks very near to for example OECD countries. So this is a very key asset for us, and it's something that the investor community appreciates a lot. In terms of inflation, you may know that there was a very strong, a very important slowdown in inflation since the end of 2016. Not only the fixed appreciation at the beginning of this period was crucial for this trend, but also there is another structural change that is related with the non-tradable inflation evolution. After registering 2 digits in the last year, there was a structural change by the end of 2015, and there is a clear slowdown in the non-tradable sector. We can see here in the blue light of this graph. So we consider that this trend is in line with a new way to renegotiate salaries. The government, unions, and companies started to implement a forward-looking approach in terms of wage adjustment since 2015. For the next 3 years, the government also suggested to both parties to make a breakdown between sectors that are in problems, normal sector and dynamic sectors, and according to them, they suggested some rate of adjustment, and we consider it was a very key and a very successful policy to bring down inflation and also to modify the inflation expectation in the market. By mid of this year, all the sectors have to renegotiate, and according to what the government announces, the idea is to continue working under this approach. And at the same time, given this important slowdown in inflation, the workers were benefit by an increase in real wage. So it was a win-win process for everybody. Here we present the public sector balance. Yesterday, the Minister of Finance released the data as of 2017, which ended at 3.5% of GDP. We are talking about the global fiscal deficit. That means, or that includes not only the general government, which is in the light blue bar, but also the central bank result, the dark blue, and the public enterprise result. There is a trend of slowdown in the fiscal deficit. The number is the lowest in the 3 years. Remember that since the beginning of 2017, the government implemented a fiscal package just to achieve the general goal that consists in end this administration by the end of 2019 with a global deficit of 2.5% of GDP. It is important to see that the general government has been doing it has been reducing significantly its deficit. In terms of the central government indicators, here we present the central government metrics. At the left, we can see the evolution of the gross and net debt of the central government. It is important to know that there is a significant gap between gross and net because of the huge reserves that the central government has. As of the third quarter of 2017, the net debt represented 42% of GDP, and there is a stabilization in this ratio over these 2 years. This is very important because after the slowdown of 2015, then the ratio of net debt over GDP stabilized. And in terms of currency and maturity, here we see in the green bar that the last number of 2017, 49% was nominated of the total portfolio debt of the central government was denominated in foreign currency, which is one of the lowest levels in the last decade. And in terms of the average time to maturity, the last figure is 13 years, which mitigates the rollover risk. This is also one of the main one of the pillars of our debt management indicators, because we are always trying to mitigate the rollover risk and the FX risk as well. Here we present something that probably you may know, because this pre-funding policy was implemented since in the last decade. Systematically, we always maintain the same policy rule. That implies that in every time the government has enough cash to cover the next 12 months of amortization plus interest payment of our central government debt. Right now, the liquid assets are equal to $2.2 billion, and on top of that, Uruguay signed with 4 multilaterals credit lines with immediate disbursement of $2.4 billion. So this policy will continue, and as you may know, this policy provides us a lot of flexibility in the moment when we decide to go to the market, and it is a very good support for tapping the market. And of course, it underpins our credit quality of our sovereign debt. The recent credit actions in the recent years, you may know that in 2012 and in 2013, the 5 rating agencies give Uruguay the investment grade status. We regained after the big crisis of 2001 and 2002. The last rating company that give a rating action was Uruguay'S, and last month in January they affirmed the Uruguay rating at BB low with a stable low. But two of the other rating agencies maintain the BBB rating, and at the same time in 2017 they raised to stable from negative the outlook of our debt. Of course, this was linked or explained by the improvement in our fundamentals, in particular with high growth and controlling inflation, as we mentioned before, and the stabilization in the central government debt ratio. So, before moving to the next chapter, we would like to highlight this new that was for us that implies that in last year Uruguay and the Finnish company UPM they signed a memorandum of understanding and investment agreement just to build another pulp mill in Uruguay, who could be the third one operating here. Of course, this investment will be the largest private investment in the Uruguay history, and previous that there is a commitment from the government to increase and to improve the transport infrastructure, in particular to update the railway system that could transport the pulp paper from the center of the country, which is supposed to, that this eventual plant will be established to Montevideo port. No? Of course, is finally this investment will settle here in Uruguay. There will be a structural change in our economy, not only in terms of growth, but also in terms of employment and effect in the balance of payment. By the way, the government invited international companies for investing in the railroad system under the PPP scheme. The invitation is open up to April, and the total estimated infrastructure for developing railroads is estimated in around $800 million. The milestone of last year was a very particular year for us, for the debt management unit, because we could tap the market, the global market, twice, issuing nominal fixed rate securities. The first one, as you may know, was in June. This one was almost 5 times oversubscribed, with a final allocation of $1.2 billion equivalent. Again, we took opportunity to make some exchange, as we used to do through liability management operation. And three years after the issuance of the 22, we could issue the 28 for a 10-year term. At that point was $1.1 billion, of which 900 million was new money, and the other 200 was under liability management exercise again. So after this both issues, we could extend the nominal peso curve, and this nominalization of our debt is we call a second generation of the dollarization in general that we started to implement by 2007 when we could complete the UI global curve. What happened with rates after these two issues? Here we present the evolution of the nominal yield in peso, the dark blue line. Then we present the real rate CPI, or sort of what we call the CPI-linked bonds. And before launching the first 22, the theoretical rate, because we say theoretical because we didn't have any, at that time we didn't have any benchmark in the market in the nominal curve, in the nominal peso curve, was higher than 11%. And the real rate at that time was around 4%. So after we launched the first one, the 22, and given that this bond performed very well in the secondary market, and 1 month after the primary issuance, the bond could enter in the GBI emerging market bond that JP Morgan published, the strong demand and the good performance in the secondary market allowed that the nominal yield was below the 10% threshold. But at the same time, the real rate come down. And this is, we consider that this is something related with the improvement of the fundamentals of our economy. So the conclusion is, because this one has more than 6 months of life, is that the break-even inflation during all this period is within the inflation target band of the central bank. Right now, the break-even inflation compensation is at 6.2%, taking into account the annual or the annual average over a 5-year horizon. Then here we can see what's happening with the FX market, which is something that in some sense is related when we explained before what happened with the current account. In the case of Uruguay, since June to the end of January, the Uruguayan peso against the dollar practically remained very, very stable. That means that compared with other peer group or with other emerging markets, or local currency neither much appreciated nor much depreciated so much. And this is very important to highlight also. Even though, as we explained in the previous slide, the nominal yield came down, when we compare with other emerging markets, basically those of them are in the BBB area, the nominal rate in Uruguay is higher, which in some sense show that the nominal peso curve reflects the commitment of the central bank and the contractionary monetary policy that they are applying is still there, and we as the government and the central bank continue working to maintain the inflation pressures under control. So just to summarize the landmark during the last year, as we mentioned, last year was the first time that we could launch in the global market two nominal peso bond on a global scale. In the case of the 28, the 10-year tenor bond, we paid the lowest nominal interest rate. Both of them could enter in the GBI Emerging Market Index produced by JP Morgan, which allowed the country to continue integrated in the financial global markets. Of course, when we designed both bonds, our intention, our primary intention was to enter in the GBI, and we consider that this is something that investor evaluates a lot. And finally, both local and international capital market funding was done entirely in local currency. So last year, 100% of the total issuance was done in Uruguayan pesos. As moving to our financial program, here we can see the fund of flow of the central government. As we explained recently, the total bond issuance in last year was in Uruguayan pesos. For the current year, We are planning to issue in the bond markets around $2.7 billion, and also disburse from multilateral $350 million. Basically, the government is committed to maintain the same strategy guideline as in the past. Right now, we are in a stage that we have to balance the goal of reducing FX exposure and the rollover risk, but at the same time, we want to ensure a very efficient secondary market, throughout the expansion of the source of funding. Of course, we will maintain our pre-funding policy as in the past, and underpin our credit public or credit profile. Our intended debt management strategy for this year, basically, we are thinking in two ways. First of all, we will continue developing the local currency bond market. As we explained, we started to build the nominal peso curve, so it's on the table to extend duration or at the same time to retap benchmarking nominal peso yield curve during this year. Of course, we will continue to target the index eligibility as in the primary market as we did with both two previous issuances. The secondary market for us is very important, so we encourage banks, we encourage investors to go and to trade in the secondary market. We encourage the underwriters to be present in the market, to provide information to the market, to provide quotes. And another important thing is that we will continue increase the share of our peso debt throughout some swaps operation as we did in recent years, in particular with multilaterals. But at the same time, we don't rule out to tap again the US dollar market, because it's the deepest and the most efficient market for us. We know that we were out of this market for 1 year and a half, and I think it could make sense to study the possibility to come again and to tap this market. Of course, this could provide opportunities for extended duration, because in most of the time when we go to the US global market, we go longer, because also the investor preference. So the concluding remarks is that Uruguay showed a very robust macroeconomic performance in recent years with a very strong growth, strong institutions. We are a very predictable country in terms of social stability. We are a country that has social cohesion, and this is something that we consider that all the investor community evaluates a lot. The priorities in terms of economic policy will continue to achieve the fiscal consolidation, continue with the consolidation fiscal package that was implemented since the beginning of last year. And of course, we and the central bank will keep inflation pressures low. The ample liquidity and buffer that the government has, it's an anchor for us, it's a key anchor for us that give us the possibility to tap the market when the market is good for us, when we see a window, and we are never in a hurry for tapping the market. And finally, we will continue developing the local currency bond markets and diversifying our investor base. Thank you very much. If you have any questions.
Now it's time to move on to the Q&A session. Our first question is the following. You mentioned that your intention is to balance the government's portfolio between foreign and local currency. But what about the terms of issuance? Is there any preference for maturity depending on the currency?
Well, as we mentioned before, when last year we tapped the market, the global market, we issued the first one in 5-year maturity bond and the second one in the 10-year maturity. In terms of the peso market, the nominal peso market, we feel that if we would like to continue developing the nominal peso curve, it makes sense for extending the duration, or as we mentioned in a previous slide, to retap in any of these benchmark bonds. In the case of the US dollar, traditionally Uruguay go longer. It makes sense to go longer because in some sense it mitigates the FX risk. We don't like to see a small tower of US dollar in the near term because of the risk or because of the FX risk. So basically the idea is to continue working as in the past, just to consolidating this nominal peso curve through our extending or through our retapping, and in the case of the US global market, try to go longer.
Okay, thank you very much. Now let's move to question 2. Are you expecting to issue in euros or yens, given the strength shown by these currencies?
Well, this question was presented in the recent years. What we have done in the case of the euros is to make some swap with existing debt. We know that we received some figure from a European investor that they would like to see Uruguay in the euro market, but we have to bear in mind that if we go to the euro market, we have to have a constant presence. So going, not going only one time, but going frequently. And according to the size of our market and according to the financial needs, sometimes it makes sense for make some swaps instead of going to the primary euro market. In the case of the yen, Uruguay issued two Japanese global yen. The first one was in 2011, and the second, this was the second one. The first one was in 2007 and was due this year, and the second one was issued in 2011. Both of them at that time was guaranteed by the Japan Bank International for Cooperation. It was a very successful transaction. But right now we are not thinking in going immediately to the Japanese market, but for a country of Uruguay, and according to the potential demand we will have in Japan, it could make sense, but maybe not in the very, very short term.
Okay, thank you very much. Another question is, fiscal deficit for 2017 was somewhat higher than the target set by the government. What should we expect for the next 2 years?
Okay, yes, as you mentioned, the fiscal deficit as of 2017 closed at 3.5%, and the main goal is 2.5%. The government has spread its commitment to continue working to reduce the fiscal deficit, and nothing has changed in terms of goals. So it is in line. This policy is in line, and we will continue working to achieve this main goal.
Okay, thank you very much. We have received additional questions. In the interest of time, we will answer each of them via email bilaterally once this presentation concludes. Thank you, everybody, for your participation. And thank you very much, Mr. Juanbel, for your exposition. And please remind that this presentation will be posted later today in our website. Thank you very much.